All right, more good news for traders seeking big returns from Pfizer's deal to buy Wyeth. Adam Johnson is back, and Adam, Pfizer says the deal is moving forward here.
Yeah, good news for people who are invested in this deal. Pfizer yesterday got the approval from the government to issue stock that will be used to pay Wyeth shareholders when the deal closes, which, by the way, Pfizer is saying is probably the end of September. And, of course, on July 20th, Wyeth will have its shareholder vote for shareholders to approve the deal. So things moving forward. And well, I didn't mean to interrupt you.
No, I mean it was questionable for a long time, and obviously you get a big return in the arbitrage deal that you've been talking about for a while.
Yeah.
What happened?
Well, I'll tell you, when we first started talking about this trade, putting on this deal, and just to refresh people's minds, what we're talking about here is buying Wyeth and shorting Pfizer. In ratio, it's almost 1-for-1. The ratio's 0.985. Okay, so you almost do it 1-for-1, and you just put that trade on, and as you get closer to the deal deal spread compresses, and finally, when it closes, they are one in the same.
But we're not looking at that 8% anymore.
Well, actually, pretty close. We're looking at 6.5%, and that's what's pretty interesting, Matt. This is what is perceived by analysts and traders alike as a very safe deal. There's very little that traders see as anything that could derail the deal. In other words, they all think it's going to close.
But why then such the wide spread still?
Yeah, I know. A lot of people are asking that. It's specifically it's about $2.80, which is 6.5% through September. If you annualize that, it's 20%. So why is it so wide? Okay, there are three reasons. First of all, these are big stocks. It's tough to keep we're talking about stocks that trade millions, tens of millions of shares a day. It's tough to keep those stocks in ratio at all times. Consider the following, Matt. The guys who have been long Wyeth have sold about 55 million shares. We're talking about the natural holders, the Wellingtons of the world, the Cap World Holdings, etc. They're selling out because they've made their money. They have to deploy their capital elsewhere. All right, and the big guy who bought 30 million shares, John Paulson, he's in. He can't buy another 30 million. So, in other words, the action has already happened, and yes, that thing will close, but there's just not enough to keep it tight. And consider also the fact, and this comes from Bloomberg data, there are 35% fewer assets in merger arbitrage. There just aren't as many funds, and that's because it got burned last year.
All right, let's talk quickly about any other deals like this then.
Yeah, there are three of them.
I mean, if that's the case with Pfizer and Wyeth, what else is out there?
Yeah, there are three of them, and they're all trading at about the same annualized return, 15 to 20%. The obvious one, Merck sharing. All right, the next, Magellan Midstream for Magellan Midstream. The third is Exelon for NRG. Again, they're all comparable. They're perceived as safe. It's just that it's tough to keep these spreads liquid, or rather tight, when the stocks are so liquid.
And there's more on the way. And we won't give it away now, but...
Well, that's right. Teva says they want to buy somebody, and again, Amgen on the rumor boards is possibly getting taken out. So stay tuned.
You gave it away, and now Jody's angry with me.